So thank you, everybody. Today's topic, as you know, is rental nation. So why do we say let's try to explain Canada's housing shift, why we are calling it rental nation now, right? Why the media is now portraying that Canada is becoming rental nation. So we'll explore that. So now, as usual, I'll do my PowerPoint presentation, followed by our expert panel, Kishore Nagarajan, Bhavin Patel, Prerna Mangal, Amit Puri, and Rajat Mangal. They are our mortgage brokers. So we need them today because we are upcoming interest rate announcement, right? So we'll definitely have their insight into that as well. So guys, get ready. You will be on the hook. Right. Next, we also have Sandeep Chopra and Chris are real estate lawyers, and Prasun Srivastava is the estate planner, and Mohit Katoch is a financial advisor, and then Deepak Sharma and Mustafa Ranawala are the accountants. So anybody have any question related to these fields, please don't hesitate. Ask our expert panel. We have a wealth of knowledge here, so please take advantage of that. Now, a quick disclaimer, as usual, as you know, we always try to compile all this information from reliable sources, but we cannot guarantee its accuracy. So please take expert advice before taking any action. Now, agenda for today. First, we'll discuss our TRREB August 2025 market report, and then we'll discuss what were the factors in the first place that fueled our market. And now we also discuss why everybody's calling that the market is crashing. Is it crashing? And what is causing this change, right? And then the rental nation, as Canada is becoming a rental nation, is it really becoming a rental nation? And let's discuss that. And then there is some story which is always there, which media is not telling, right? So we'll discuss that story as well. And then, as I already said, we'll ask all our expert panel about our upcoming interest rate announcement, which is going to happen on September 17th, which is this Wednesday. And then we'll have a Q&A session. So now let's discuss our TRREB report for August 2025. So number of units sold. We sold in August 5,211 units, which is 2.3% more than August last year. So good positive direction. Yes, we sold lesser homes than July, which media is saying, and a lot of people are saying that yes, we came down, but it's always seasonal shift. Summer is always slower. July was unusual month when June and July, we sold more homes than in spring, but August was a usual August, but better than last year, right? Why do I say that? If we look into this graph, you always see that in normally August is always lower than July. So there's no change. It's not surprise. This dark green line sitting at the bottom is August 2025, 500 to 5,211 sales, which is better than this light violet line, which is 2024. So yes, it's almost the lowest ever August, better than last year, right? Now, if we look into our months of supply, so we are at 5.2 months of supply. What does it mean is that if we do not have any new homes coming to the market for sale, it will take 5 months for all the homes to sell, or 5.2 months. So less than 4 months is considered as a seller's market. More than 6 months is considered as the buyer's market. Between 4 and 6 months is considered as a balanced market. So we are in a balanced market territory. It's not a buyer's market, it's not a seller's market, right? And yes, we are about 16% more than August last year. Just again, it has been happening for the last many months, and we are about the same trend. Right. So this is what I mean to say when we are following this trend. Yes, it became scary when we had more than 30,000 homes to sell in the month of May, June, and July, but now we are down to 27,000 homes, right? So yes, inventory is still high, sales are less, inventory is more, which is the story, right? Everybody knows that, but it's going in the right direction. If you look in the direction, we are coming down in the number of homes to sell, right? Which is a good story. And then if we look into our price, average sale price is down 5.2%, right? We are at a million in 2022, sorry, million in 22, down 5% than August last year, or maybe even 2.5% down from July of this year, right? So prices are softening. But people, again, there's another story behind it. Prices are softening. You know why? Because we are selling more homes which are at the lower end than the homes we sell at the higher end, right? Houses 2 million and higher are not selling or selling very slowly, right? Taking much longer, much lower number of sales. Whereas less than $1 million homes are moving faster. So that brings overall prices down. So yes, average price is coming down, prices are softening, but it's not scary, right? So if we look into this is very important. I want everybody to pay a little bit attention here. A dark green line, which is August 2025, if you feel it's almost in the top, we are still almost near the peak. The peak was in probably 21 when we had highest August pricing, right? But we are not way far behind. Yes, if we look into this light green line, when we actually went up to 1.3 average sale price, which was wrong. We all understand it now. That was not sustainable. That was wrong pricing in 21, 22, early 22 when we touched this like 1.3 mark, 1.25, 1.3, even more. But that suddenly came down, and we are after that not going down too much. So average sale price, our market is still sustaining, and it will sustain, and we'll discuss that later on, right? Now, this is when I say our average number of homes sold is good number of sales. This is normally the seasonal trend. This is how normally the action happens because we have different seasons in Canada, and based on the season, we have different activity in Canada, right? We normally have high number of sales in fall and in spring, right? So fall means September, October, November, right? Or September, October. So September, October last year, we had good number of sales, right? And then November, December, we went down, which is usual. Then usually we should come back strong in March, April, which we did not last year or this year by March 25 or April 25. And we all know it was because of Trump impact, right? I don't have to say that again. But see where we were in June, July. We had, like, this is very rare that we had such a high number of sales compared to spring in summer, right? So June, July, we had more than, or May, June, July, we had more than 6,000 sales every month, which is very good number of sales. Yes, we came down a little bit in August as usual, and but we are expecting to bounce back in September. We'll have probably more sales in September than September last year as well. So the trend will continue, right? And if we look into the price, yes, the price is softening, it's down. But again, if you compare with the highest price last in this year or the last year, we are not too far away. We may be 5% below than August last year. We may be 2, 3% below than July, August this year, or May, June, July this year, but we are not way behind. And this is again seasonal trend. Prices again drop a little bit in summer, come back a little bit better in again fall, and again drop in winter, which is usual. So we are in a stable market. And I shouldn't say stable. We are still in softening market, but we are not having any crash or anything which people are thinking. Right. Now, let's do some micro analysis. Number of sales for detached semis, townhomes, and condos. In detached sector, we sold 2,411 homes out of 12,000, which is 5.19 month of inventory, which is at par with the overall market. But semis and townhomes, we are 3.4 and 3.7 months of inventory, which means we are in a seller's market. So let it sink in. We are still in a seller's market for semi-detached houses and townhomes as far as the inventory is concerned. Condos, we are 6.7 months of inventory, which is closer to 7 months, which is definitely a buyer's market. But if you remember, few months back, we were about 8 months of inventory. So we have come down from 8 months to less than seven, which is going in the right direction. So suddenly the market is now getting better, right? So that's the story. So if again look into here, 5.2 months of inventory for detached, 3.4 and 3.7 months of inventory for semis and townhomes, and 6.7 months of inventory for condos. So still a balanced market for detached, seller's market for semi-detached houses and townhomes, and a buyer's market for condos. Now, this is another story which media is saying and everybody's saying, hey, we dropped $400,000 in average sale price for detached homes in GTA. Yes, we did. In March, our average sale price in March 2022 was 1.7 million, roughly. And now our average sale price for GTA is 1.3 million, which is a drop of almost 400,000, right? Actually, for Toronto, average sale price only for City of Toronto in April 2022, when the peak was there, we were at 1.95. Right now, in Toronto, average sale price is 1.5, which is more than 400,000 drop in average sale price. Yes, it's scary when you read the number, when you read the headline that detached home prices dropped over 400,000 since peak. But if you keep in mind, we grew almost that much price in 1 year in 21. If you take that 1 year out of equation, 21 and 22, when that frenzy happened, right? We all know now, we all accept whatever happened was wrong, right? If we take that frenzy out, this 400,000 is the gain which we made in that 1.5 years. So we are still in a better market than 2020 or 2019 or 2018. So yes, the headline makes a lot of noise, but no one tells you the real story that yes, we are still in a very good segment. I feel bad for people who bought during that frenzy period and they are losing a huge amount of money. It's not that we don't feel bad for them, but at the same time, overall, the market fundamentals haven't gone wrong, right? So what actually happened? Why the market went up that much in the first place? Let's quickly discuss that, right? So factors that fueled this market to go out of control. First, population growth and immigration. In the last 2 decades, Canada immigration has grew up significantly, right? So that was probably the government policies. They wanted a lot of people to come to Canada, and most of them came to Ontario, and most of them actually came to GTA. So 40% of all the immigration comes to like Ontario and mostly in GTA. And that's why GTA became a hub. Everybody wanted, there was a lot of demand for the houses. And on top of that, there was a lot of international students and work permits, which added to the rental and the demand and the ownership pressure. So all of that caused a huge growth, right? Huge demand. Second, limited supply. And suddenly we didn't have enough houses because we have strict zoning, lengthy approval process, and then greenbelt restrictions. Actually, we have probably one of the strictest, the most strict zoning requirement in the world. We take most lengthy approval process in the world when it comes to development, right? And because of all these, construction could not keep up with the demand, especially in the GTA. And that caused all the market to boom, right? Another factor, interest rates and easy credit. Since 2008 market crisis, whatever happened in US, that meltdown, since then, money became very cheap. People had access to too much credit at a very low rate, right? And because of that, it actually went up very high in 2016, 2017. Then government introduced stress test to slow it down, right? Which initially helped. The market started coming down, or actually, I should say it was controlled. But then COVID happened. And after COVID, we all know what were the interest rates. We were getting interest rates, mortgages below 2%, never heard of before. And everybody again went to the frenzy, and we had that unsustainable growth in the household market, pricing at least, right? And then next come investors and speculative activity. Canada has a lot of investors. Actually, everybody became an investor in Canada because this was a story which, whenever you go to any events, any family events, any gatherings, everybody was telling each other, hey, I sold the house within 6 months. I bought it and I made 50,000, 100,000, 200,000, right? So people are making a lot of money in real estate. So real estate became like stocks. So people were buying them, flipping them within few months and making huge money. So because of that, there was a fear of missing out. So everybody jumped in. People leveraged their principles, and people wanted to invest in real estate and make quick money. And that caused a lot of growth. Next, economic and job growth. Canada, or Toronto, became a major global tech like hub and the financial hub. Because of that, there were a lot of jobs that were created in Canada. These were high salaried, stable jobs. And because of that, a lot of young generation suddenly felt that they can spend a lot of money. And people started buying homes, right? And then government incentives. So on top of that, government wanted to boost the home ownership, right? So they gave incentives for the first time buyers. It's probably Canada is one of the very few countries, and again, I can ask our mortgage brokers at the end of the session. They can tell me if there's any other country in the world which has similar programs like CMSE insured mortgages, where you just pay 5% mortgage or 5% sorry, down payment, and you can get the mortgage, right? So that type of activity fueled the market. And then they gave a lot of tax rebates to make it even more easier. Then, on top of that, there was global capital and safe haven effect. Canada is viewed or was viewed as politically and economically stable country. We are still politically the most stable country in the world, probably, and economically as well, right? Because of that, real estate in Toronto and Vancouver became a global safe asset for wealth preservation. So a lot of people from overseas, from countries like India, China, Middle East, many other countries, Europe, they wanted to park their money in Canada, right? So a lot of money was pumped into our economy from overseas as well, right? And then urbanization and lifestyle trends, because people want to live where the action is, right? So desire to live near jobs, school, transit, cultural hubs, all that kept Toronto as the main hub, right? Toronto and Vancouver. So that's why these two cities gained substantially. So all these impacts actually made our housing market unaffordable. So in summary, strong demand caused by immigration, jobs, and investors, constrained supply, and cheap money. All these caused our market to surge significantly, right? So then what changed now? Why are we calling it a crash? Or is it a crash? But what is causing this downtrend? First, now let's discuss interest rates. Suddenly, interest rates, which were under 2% for mortgages or almost 0% for Bank of Canada's rate, went up beyond 5%, right? Mortgages were close to 6, 7%. So suddenly people could not afford anymore. Money was not cheap anymore, right? So our Bank of Canada's governor, which in 2021 said to everybody, hey, don't worry, these low interest rates are going to be there forever, or at least for long term. So you don't have to worry. You can go out and spend money and invest. Suddenly, within a year, within a few months, they pumped up and they pumped up significantly and too fast, too much. So suddenly people had no money left, right? And then affordability. And because of all this, inflation rose a lot, right? Cost went up, income didn't go up that much, borrowing became much more expensive. So a lot of people cannot afford houses anymore. Like they cannot afford principal plus interest plus taxes plus utilities, all them together. This became unaffordable, right? And that caused the demand to go down. And that caused buyer sentiment and confidence to go down, right? Sentiments and confidence plays a very big role, right? Initially, there was a fear of missing out. Now, fear of overpaying. People saw markets dropping. People don't know how much it will drop. And because of that, they are not ready to make a decision because there's no confidence yet, right? So this is opposite of FOMO, fear of missing out. So there is a confidence missing right now in the market. That's another big factor. Then the surging inventory and the weak number of sales. As we just discussed in the few slides before, our active listing crossed 30,000 mark first time in GTA in 2025. That never happened in the history. So we have so much supply, very little demand. So that is causing the market to come down, or in media's word, crash, right? Which we do not agree, but let's look into that. Another thing, mortgage stress and renewals looming. So this mortgage stress means people are having a lot of stress because they know their mortgages are going up. And they also know many people who bought homes in 2020, 21, 22. That's the time when most houses were sold and people got lowest interest rates ever. All of them are due for renewal, mostly between 3 to 5 years, right? Because most people get mortgages for either 3 years, 4 years, or 5 years. So come 24, 25, 26, most of the mortgages are due or were due for renewals. And that caused a lot of stress. And then finally, Trump impact. Now you could see, you know what? A lot of people say US policies or Trump has caused our Canadian market to crash. I would not agree completely. We were already down. We were already down too much, right? Before Trump came in. But what it did, we were on a comeback story. We started coming back in October, November last year when the market started seeing a good action. A lot of activity was happening. Prices were getting stable. And we were expecting a much better market in 2025. Then came Mr. Trump with all his rhetoric, with all his threats to Canada. Suddenly we went in further down. We went in a bigger hole, right? So that's another big impact. We all know that. And then what that did, our GDP went down, right? Our GDP growth has slowed down significantly, and our job creation has gone down. So people are now more worried about their jobs and GDP. So that's causing people not to make big decisions like home buying. So now, because people are not buying homes, they are renting. So is Canada becoming a rental nation? Because it doesn't matter whether you buy or rent, you need a house to live, right? And that's what's happening. People are now renting more than ever. So, which in other words, now we want to discuss, is Canada becoming a rental nation? Let's discuss that. First, purposeful built rental construction. These are the buildings or the units which are specifically made for rental purpose. So 5+ units, so buildings or small units which have at least 5 units, those are called purposeful built rental. So their construction has gone up significantly in the last few years, like 22, 23, 24. We have seen the most number of purposeful built rental in Canada. It's as high as 1970s, right? So this is a graph or a slide. Now, what is causing it? What is causing this big growth of purposeful built rental? There are three CMSC programs which are funding it. They are called ACLP, MLI Market, and MLI Select. So these three programs are boosting this growth. So because of that, so this is their impact. So initially it was the ACLP program, which was and the MLI market program came in 2017. And then came MLI Select program, which just suddenly came in 2020 later and later on. So now that's the program which is causing the most developers to seek easy loans and go into purposeful built rental rather than making homes where people want to live or buy and live, like home ownership. So these are buildings which will never be owned by any individuals or end users. These are the buildings which are now built only for rental purpose, right? So what are these three programs? A quick summary, a quick comparison. ACLP is where CMS is actually directly giving money to the developers to build these rentals. But later on, what CMS is doing now, they're insuring the mortgage. So lenders, banks and the big lenders, they are lending the money. CMS is not lending the money into MLI program, which is mortgage loan insure programs. But CMS is insuring their mortgage, and that's causing all these big jump or surge. So MLI Select program, they have to make some units more affordable, and they have to have green incentive, and some unit has to be accessible, the rentals. So if you add these incentives in there, then you can get up to 50 years amortization at a much lower interest rate than the market for developers or for the builders. And that's where a lot of new construction is getting done. So yes, because of all these reasons, so we can say our average age for the first time home buyer in Ontario is now pushing further down the line. In 2014, the average age was about 36, 37. Now it's almost 40 years. So, which means it's taking much longer for a first time home buyer to have the home ownership. So, is Canada becoming a rental nation? We can say to some extent, yes, as of now, because of these policies of the government, because they are causing purposeful built rentals to rise significantly. Affordability is declining. Federal government is allocating its resources towards the rentals rather than home ownership. And average age of first time home buyer is on the rise, right? But this is again a temporary fix. It's not a permanent fix because it doesn't matter what happens, home ownership is always the biggest dream of any individual or families, right? So it will change and it will come back. Now let's discuss. There are some stories which media is not even telling us, right? So media is all talking about negative stories because negative news sells much faster or much more than positive news, right? So what is the positive news? We still sold more than 5,200 homes in August. We sold more than 6,000 homes in July. right? So those are the big stories or the big news, which again, they are not portraying it as much as they should. Well-priced homes and well-presented homes are still selling fast. Why do I say that? Last month, in the month of August, 766 homes out of that 5,200 homes were sold for 101% or higher, which means they went into multiple offers and they sold for more than their asking price, right? How much is that? It's almost 15%. So 15% of these homes still sold for in multiple offers. So multiple offers are still happening, right? Although we are not hearing about them. I can show you one multiple offer just happened last week. This house was sold with 18 offers, sold in 7 days, sold 30% of our asking price. It sounds like it's 2021, right? Or 2022, but it happened last week. And there are many, many more like these still happening, right? But again, media will not tell that as of now. Average price, if you look into this now, this is the last 24, 25. Are we crashing? Are we going down huge? If you look into blue line, which was 24, and red line, which is 25, we are very, very close. And we are going to be similar to that. And once the confidence comes back, anything happens, whether we have a trade deal with US, we have been saying that for a long time, or some positive news with other countries, with Canada becoming, as we are opening our trades with many other countries, as we start becoming a more stable country, it will change very quickly. And number of sales, if you look into the red line, which is 25, and the blue line, which was 24, yes, we were selling much lower number of homes early part of this year. That was the Trump impact. But now we are at par or even more than last year, right? This blue line went up huge in October last year. And that's when I said it was a comeback story. We started saying that market is coming back. And actually, it felt like we would be having a very good 2025. But then after that, November, December, we had a nosedive. And we all know why. Mr. Trump won the elections in US and he started making all those threats to Canada, right? But now we are about to beat it. We are very close and we are actually forgetting about whatever he's saying. No one is paying attention now anymore. So that news, every day we were only talking about Trump. Now, no one is talking about Trump anymore. So that's a good news, right? Now, let's look into this graph. We have seen this many times before in my presentations. I have presented it many times, but again, let's look into it in more details or more closely. 1973 average home price in Canada was 40,000. End of 24, after all the decline from 21, 22 pricing, we were still at 1.17. 1.117, sorry. So 1.12, close to that. So which is almost like 27, 28 times than 1973 pricing. Or we can say we grew up at 6.72% annually, month over month, compounded for that 50 years. Huge growth, right? And now, doesn't matter what happens now in short term, I can definitely say with confidence here that in 35 years, come 2059, like 35 years from today, or 2060, our average home price will be at least 3 million to 6 million. And this is not at 6% growth. If we grow only 3%, half of the growth, less than half of the growth, what we had in the last 50 years, we will be more than 3 million. At 5%, will be more than 6 million. So we all can agree that we will be somewhere in between that. So if you know any house you buy today closer to $1 million will be more than 3 million in 35 years. Is that a bad investment? I believe still is one of the best investment you can do. You know why? Leveraging. To buy $1 million home, how much money you need to pay down? You can still pay only $50,000, which is 5%, or 20% if it's an investment, which is 200,000. And that 50,000 or 200,000, if that can give you a profit of almost $3 million in 35 years, and if you are end user or it's your principal house, then this all is tax free. Where can you grow that money anywhere else? Think about this. So let's now discuss our upcoming interest rate announcement, which is coming very soon, right? So I'll again not make much predictions here. This is the media news. I just want to bring it up. So we have this rate cut on the way as per media coming on September 17th, right? So there is a lot of lost jobs, and which is people are expecting to have a cut. This is a Reuters poll, which says that we will probably have a rate cut come September 17th. So, what to expect? So, the consensus in the media is there'll be a drop of 25 basic points. So, we will come down to 2.50 from 2.75. But again, I'll leave that to our expert panel and we'll ask them this question very shortly. But before that, if you have any real estate needs, if you want to discuss this, if you want us to analyze your properties or your portfolio or your needs, the real estate needs, please contact one of us. Thank you. Let's now open the session and let's now discuss with our panel. As I said, let's discuss first upcoming interest rates, right? Because everybody wants to know and everybody wants to hear from horse mouth. So without further ado, let me ask my expert panel, who wants to start? Amit, Kishore, Bhavin, Prerna, jump in.
I can go. Yeah, I can go first. Definitely, we can see that, sentiments, not even sentiments, people strongly feel that there will be a rate cut of 25 basis point. And there are multiple factors that are making us think that not only the unemployment rate, which has gone up to 7.1%, but also if we can see the inflation is still under 2%, and that is something that is doing that, and GDP growth is also slowing. So all these factors are pushing us to think that, yeah, there will be a rate cut of 25 basis point.
Okay, so Prerna predicting
I
25.
strongly feel that.
Okay.
Kishore, don't jinx it, okay?
No, 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 we want it. We all want this.
Yeah.
Yes. Amit, you want to take the shot?
My pleasure. I agree with her. I think 25 for sure on Wednesday. The reason for this is, limited new housing supply that's on the horizon, the immigration cuts that have happened. Cost of construction is skyrocketing. I think Peel Region just cut their development costs by like 75% for the future just to get builders to build again. So I'm going to be aggressive and say we should have 1% reduction by spring. And whether they do quarter or half on Wednesday, they'll make up the rest before the spring market. So my target is 1% in 6.5, 7 months.
Wow, that's very bold prediction. Amit, I'm happy. You don't
We
get.
need it. I mean, the market's suffering. Housing is the engine that runs the Canadian economy. When you buy a house, you buy appliances, you buy TVs, you buy rugs, you buy furniture, you have parties. It's a catalyst for the Canadian economy. If we were based out west in Vancouver, we'd have, minerals and forestry and mining and stuff. But for Toronto, unless you're in banking or finance, the secondary market is housing, and housing drives the entire Ontario market. So they have to make some changes, or we're going to head into further trouble.
No, we like it. You know what? I can tell you all our audience, they love it. Whatever you told them. So that's a bold prediction. We love it, right? But 25 points this time or more.
Oh, I would say 25 for sure. I think 50-50 they go for 50. It really depends on, like, I know the US employment number losses were higher yesterday. The problem is the Dow keeps skyrocketing and the S&P, but that's more an indication of emotional connection to the market. So it'll really depend on what Macklin thinks of what happened. So I hope they do 50. I'll say that. If they do 50, at least we can have a good holiday season.
That's great. So, you know what, everybody, again, I don't know whether you guys know or not, but Amit is a chartered accountant as well. So he is also into numbers. He's a numbers person, and he's very strong. That's his strength. So that's why when you see him talking, he also talks about a lot of other factors, right? He doesn't just throw the number because of his background, and we appreciate that,
I
Amit.
appreciate that,
Thank you
Sam.
for your
Thank you.
feedback. It means a lot. Thank you. Yes, so Amit is 25 for sure, 50-50 for 50. Let's go to Kishore. Yes, Kishore, jump in.
Sam, yeah, we're going to get 25 for sure this time. I
Okay.
think yeah, it's going, but I'm not, maybe it'll be a soft landing. I don't know how aggressive they're going to get, but 25 for sure this week, coming week is my prediction.
Okay. So, guys, we all know Kishore is the most conservative guy in our group, right? He always is very conservative. That's the word, minimum word I want to use, right? He doesn't want to be over optimistic. Let's be honest that way. So he's saying 25 for sure, which means for sure.
If
Good.
he thinks 25, I'm going to change it to 75% chance to fall.
So 25, 25, 25 is 75. Okay, guys? There you go.
That's
Good chance they make.
that's great. That's great. So yeah, so let's be 25 and 50. So let's ask the next one. So Rajat, do you want to
Bhavin.
jump in?
Hi, good morning, everyone. Yes, I think it's 25% for sure, and I really want to see 50%, sorry, 50 basis point cut, but 25 for sure.
25 for sure. Right.
Yeah. So
Where is Bhavin?
Bhavin, he had his son, had some class, some festival today, so he's with his son. So he did mention that he may be muted. He may be in the session. Do we see him there or is
Yeah,
not
I'll check it. I think I saw him. I think so.
there? He was there in the beginning, but probably he
Yeah.
went out.
So yeah,
As I said,
probably
he
he
does
went out.
have his
He
son.
did not give his prediction.
Fair enough. You know what? We'll ask him next time. So, but we got very good
Yeah.
prediction from four
Yeah.
different experts we
Mm.
have today. And now let's open the floor to our audience. Anybody have any question for one of these experts we have here? Or any other expert like mortgage brokers, accountants, as I said, or financial advisors, everybody's there. Audience?
Sam, I just wanted to add one more thing. A lot of lenders, and especially one of our specific lender, they
Mhm.
dropped their fixed rate as a promotion. So insured deals or mortgages that we're talking about, the rate is currently 3.69 for 3-year fixed. And for conventional, it's 3.99 for 3-year fixed. So anyone who is a first-time home buyer or looking to put a down payment less than 20%, take advantage of this now. This is a promo which is till September 30th and apply till October end. So
Great.
yeah, so
Very great.
anyone who is in the market, this is the time to book it and to get the mortgage or get approved.
Great. The good news is now, if I'm right, and again, our mortgage expert panel can answer that as well. The fixed rate interest rates have already come down,
Yeah.
right? So it's not, we are now whatever we are talking is a variable rate or Bank of Canada's rate, which does impact the variable rate. Fixed rate is independent of this Bank of Canada's rate. in short term at least. In long term, it does have some impact, but not in short term. Short term market is driven by the bond market. So long term market is driven by the bond market, the fixed rates, and that's has already changed. So we have already seen good drop there, and hopefully the trend continues. Let me ask our expert panel again, the mortgage expert panel. Where do you see interest rates, the fixed rates? Because variable rates, as Amit predicted, and probably the others would agree, that we would definitely drop at least 50 to 75 points by spring, if not 1%, because Amit is bullish and we appreciate and we agree and we want to agree to him, right? And we would love to see 1% drop by spring. But let's be honest, at least 50 points is this year. That's what they're saying, right? I think most expert panel will agree. And there may be some more cuts in the next couple of months after that. So if that is true, where do you see the mortgage rates would be? And that would help a lot of people to decide whether they should go for fixed rates or variable rates come next year, right? Because a lot of mortgages are due for renewal now in next 3 to 6 months, or most by 1 year mark. So what would you guys recommend as an expert on the mortgages? So if one by one you can also give your opinion on that, that will really, really help all our audience. So let's start. Amit, you want to start with that?
My pleasure.
Yes.
I think we have to just do a 10-second history lesson on the rate. So variable is based on 90-day GICs. When a bank sells a variable, they lock it to a GIC. That's why the penalty is 3 months. Simple math. When they sell you a fixed, they buy a corresponding bond from the government at 3.99%, and then they give it to you for 4.99%. So when they break it, they got to pay that bond penalty. So when we understand that, we can try to understand the trend. So the consensus among the bank chief economists, TD, CIBC, Benjamin Tall is one of the gurus of the industry that runs CIBC, where Kishore is, and the expectation was that rates, the overnight prime rate, will fall 3% from 25 to 27. So we've already seen 1.25. So we have to see another 1.75 by 2027, which is only 15 months away. So between 15 and 27 months, I expect 1.75% reduction. If inflation continues to do what it's doing and the markets continue to fail and AI keeps taking jobs, then they're going to have to do that stuff. So fix will follow. Fix should settle around 2.5%, 3%. Variable should settle around the same. And if I'm guiding clients today, I would put them in a variable because I expect rates to go down. So if you sell somebody a 4% fixed, by summer of next year, they'll be upset with you because the rate should be 3.5. So my advice right now is variable.
Great. Thank you. Very detailed answer, and I like that. Now let me ask Kishore. What do you say, Kishore? Our conservative.
Sam, so majority of Canadians are in fixed rate. So over 70% of Canadians are in fixed rate, right?
Yes.
And I tell clients this, look, pre-COVID, the 3-year fix was 349. So if you get 369 today, you're pretty much there where pre-COVID rates were. We're almost there, right? And in a normal world, pre-COVID, again, variable rate was the delta between the fix and the variable was 75 basis points. If you got it at, variable rate must have been 295 or, high twos, fix was mid threes. That's the premium you pay for fixed peace of mind. For me, choosing a product is always about what you can afford, right? One of the things that concerns me is this tariff pressure is inflationary. If you get hit with the true brunt of the tariffs and we see inflation again and rates go up again, can they survive? What's your fallback like? It's fun to plan on a best case scenario, but I always want to make sure they answer what if you can manage the worst case scenario, then yes, it makes sense.
Fair enough. Okay, so Kishore is still recommending based upon your own situation whether you should go fixed or variable. It's how much appetite you have, how much risk appetite you can
Yeah.
tolerate, right? So that's a good advice, and we appreciate that. And Prerna, what do you say?
So yeah, Sam, yeah, Sam, I agree with you. It really depends on the risk appetite of the client. If they can take some risk and they are okay with that, I advise variable. But anyone who is first time in the market and they are very, skeptical whether they should buy or not, so I suggest fixed. And fixed for insured 3.69, it's pretty good. And conventional, if they're putting 20% or higher, 3.99 that they're getting. And you know what? We are able to get them approved and they are able to afford the houses in this market where they can buy the houses at a lower price. They want to take that advantage and with good rate. So definitely it depends on the risk appetite too.
Great. Thank you.
Yeah.
And Rajat, what's your advice to your clients? Is Rajat still there?
I think he just dropped.
Okay, he got dropped. That's fine. So we heard from our expert panel. Again, it depends upon your personal situation and if you have a risk appetite, and especially if you're investors, right? For investors, I think everybody would still advise going variable, right? I think Kishore will also agree with that because if you're an investor, you may have to sell the house anytime, right? The situation and it's not a permanent house. You're going to live there for a long time. So definitely variable. But if you are end user, it's your principal home, then probably you may consider variable or fixed depending upon your own situation. Amit is definitely going to advise variable, as he said. And I know Bhavin is not in today, but knowing him and whatever he mentioned in last two sessions, he's also advising his clients to go for variable as of now because of the same similar reasons that he's also expecting the rates will drop more in the coming few months. So I think as we are going to have one drop in September, for sure, most of people are saying, and maybe a few more drops down the line. So not a bad choice to go variable as of now. But again, that's your own risk appetite and your own situation. Keep in mind, if it goes up, you will have to be at that as well. Now, I think there are a couple of questions in our chat. So, Neelam, if you can
No,
read
there is
those.
the answer has been done. So they
Okay.
thanked. So yeah, it's done.
Okay, so yeah, one question was about many renewals. So one of our client has many renewals coming up, and so in the
Pankaj
next
asked
6 months.
now.
So what you
Panchak
recommend?
asked new question.
So
He said, hello, would you advise breaking a fixed of 5.2 to variable?
very good question. Who's going to take that?
Sam, I can give it a shot. I mean, Pankaj, you got to find out what the penalty is and do a cost benefit analysis to find out, okay, this is my penalty, this is how much I'm going to save. One of the tricky parts of locking it now is, as rates are coming down, you might lock it in, say 399 and then pay this penalty, and all of a sudden you find out it dropped even more, right? So that is something you'd have to look into. But if the numbers make sense, and if you're in that sweet spot where you're not getting charged IRD for breaking it, and I mean, when I say IRD, the interest rate differential, you might be getting just charged 3 months interest, then the numbers may work.
Yeah, so I think it's a very tricky situation. You have to sit down with one of these experts to understand how much penalty is there, and does it make sense for you to break your fixed rate mortgage and go into variable or maybe a lower rate fixed rate mortgage. Amit, what would you advise Pankaj on this one?
Exactly what Kishore said. We need to know what the penalty is.
Yeah.
Problem is, On $1 million, the penalty can range from 4,000 to 40,000. So until we know what it is, we don't know. It's a quick answer. We would just need to, the client should call the bank, just confirm what is the actual penalty, and then exactly what Kishore said, just you do a cost benefit. Does it make sense? And then if it does, go variable and ride the wave down. I mean, the other thing about this business model is you're selling, to investors and people getting into the market. It's the time to ride it down. So, the only one of the things I don't like about fixed is that the penalty is always so high. So people get stuck. As much as it creates certainty for cash flow, you could save 150 bucks a month, but then, the other statistic, which Kishore is right, 75% of mortgages are fixed. But the other statistic that Canadians don't know is that 63% of all mortgages are broken before the mortgage is up. And the reason is divorce, separation, kids got school, renovation money, upgrade, downgrade, blah, blah, blah. You name 100 reasons why people. None of us can tell you where we're going to be in 5 years, let alone where we're going to be financially. So for that reasons, 60+% break. The banks know this. The profit margin for the banks is based on mortgage penalties because that's what I used to do when I worked at head office. So I don't like fixed only because it's a trap for people that break it. If you lock in a low rate and you know you're not going anywhere, if you're a retiree, if it's an investment property you plan to own for 30 years, cool, go for it. But the majority of us don't know what's going to happen next week, next month, next year, let alone 5 years from now. So I'm not going to say hate, but I dislike the fixed product because it causes people to get stuck. And when I get the call from a client, hey, I had to move my job, something came up, and the penalty is $55,000. Every nickel you save them with the rate, they're pissed off. So I try and avoid those calls at all costs.
Awesome. Very great. Very good information. Thank you.
Thank you. And we're up time.
You know what? I know as much as we want to continue, it was a very healthy discussion and very insightful. I really appreciate our expert panel, especially the mortgage brokers today, because this was a hot topic and everybody is talking about it. And we all want to know what's going to happen come this Wednesday when there is going to be at 9:45 a.m. Our Bank of Canada's Governor Tiff McCallum is going to make the call. Right. But again, as we all know, the call is just a formality. A lot of financial advisors actually will tell us by Tuesday, almost with certainty, what's going to be tomorrow. Right. So keep on watching the news and we will find out. But for sure, there'll be a drop of 25 points, as we heard here. And then it can even go up to 50 points, right? As 50 for 50 from our expert Amit, right? So let's see how much it happens. With that, again, I know there are a lot of people still thinking about their condos investments and condo properties, which we did not touch today. It's not that I didn't want to touch or I didn't want to discuss it. I know a lot of people have those questions on condos and they wanted me to even consider it and ask it. But because today we had so much different things to cover, I could not and we could not include that in our today's discussion. But I promise you next time we'll definitely include that. And if you guys want me to have any other topics to be included, please let me know and we will include that and we will always ask our expert panel to chip in. Thank you, everybody. Thank you for your time today. It was a very informative session for me as well, because I did hear a lot of good information from our expert panel. And we thank you, everybody, for being present and sparing your valuable time from your family, away from your family on this Saturday morning. Looking forward to our next session. Thank you.
Thank
Thank
you.
you. Thank you,
Thank you,
everyone.
everyone.
Thank you.
Bye, Sam. Bye, guys.
Bye.
Bye.